Welcome to part 3 of our series on trading strategies. Last time we discussed trend trading and scalping. Today we're diving into swing trading and news trading. Hey there, I'm Eva and let's start with swing trading. Swing trading is based on using short-term market fluctuations. Here traders buy assets when they see potential short-term upward movement and sell when the price reaches a temporary maximum. Positions are held for several days or weeks, making this strategy less stressful than scalping, but it still requires attention. Pros of swing trading: more time for analysis. Swing traders can spend more time studying the market. Larger potential profits. Unlike scalping, swing trading allows you to earn on more significant price fluctuations. No need to constantly monitor the market. Although the market is volatile, swing trading doesn't require you to spend all day looking at charts. Cons: risk of sharp market changes. While a position is open, news or external events can suddenly change the trend. Need for patience. Sometimes you have to wait several days or weeks to see how the market turns in the right direction. Now, let's talk about news trading. This strategy involves making trades based on important economic news or events that can strongly influence the market. Traders using this strategy buy or sell assets depending on how the news can change the price. Pros of news trading: quick reaction to changes. Good news can quickly raise asset prices, giving an opportunity to earn if you make a trade in time. Easy to understand, anyone who follows important news can use this strategy. Cons: risk of misinterpreting news. Even positive news can affect the market differently than expected. Competition: since news affects all traders, many strive to make a trade simultaneously. Have you ever tried trading based on news? What was your experience? Share in the comments. In our next video, we'll explore arbitrage trading and dollar cost averaging DCA. Don't miss it!